Welcome to Broken Pie Chart Podcast, episode 114. I'm your host, Derek Moore, and today we're going to be asking, what exactly is a SPAC, S-P-A-C, or Special Purpose Acquisition Company? What are these? Why are they gaining in popularity? And kind of what are some of the potential pitfalls? What are some of the good things about them? I want to give it just a general idea of what they are, since they've been in the news, and a couple people said, hey, what is this stuff I read about with these blank check companies, and they bring people public? Are they good or bad? And why are they gaining popularity? Well, SPAC, again, stands for Special Purpose Acquisition Company. And I mentioned it in the teaser. It's a lot of people refer to them as blank check companies. And basically what happens is a manager, and so Chamath is one of the big ones out there. I think there's been some other big names. And they basically, go ahead and raise money, raise capital, and they raise it from investors. And the idea with a SPAC is, hey, give us these funds, and we as the manager will go and we'll find something to go into. And if we can't find anything, we'll return your capital. So you're sort of putting your faith and trust in these managers that they'll vet a company that's private and eventually, bring it public. And so the thing with a SPAC, though, is if we think about, and I'll just kind of explain the general timeline of these. So it's sort of like, it could take like 2 years is generally the idea here. And so in a SPAC, think about, that same manager, they go out and they raise funds and they say, and this is why a blank check, if you're investing money in it, you don't know essentially what they're going to do with the money. But they create these SPACs, they go ahead and raise the money, but they do an IPO, which is initial public offering. And so you've got this company, this SPAC, that's trading on a market. It IPOs, meaning it's a first public offering. You can, as an investor, you could buy or sell shares in it as you're sort of waiting to find out, what they're going to invest in. And over that time, basically they go and they look at companies. They look and they search for private opportunities, and they have to, I imagine there's some negotiation that goes on, there's some back and forth. But a good example of this, I believe, wasn't it Virgin Galactic eventually went public through a SPAC? And I don't have all the details on that, but in that case, the SPAC was trading under some, symbol that didn't really mean too much. And then eventually the SPAC merged or acquired Virgin Galactic. And then eventually they changed the ticker symbol and changed the name. And then Virgin Galactic essentially was took the place of the SPAC name and the SPAC symbol and just was trading on its own. But it was a way that they brought that public. And so if you think about this, you've got to find this company. They'll have, I imagine, there's probably a vote by the shareholders. And so what happens is, at the end of all this, and they only have 2 years. So that's an important thing, because let's say they raise all this money and they talk to companies, they can't create a deal, or they don't find anything. They'll actually have to close down the SPAC and go ahead and return capital money to shareholders. If they find something and it's approved, they do what's called a SPAC merger, and basically they merge with one of these companies. Remember, the SPAC is just a blank check company. They don't do anything. They don't make anything. They don't sell anything. All they're doing is they're looking to see if they can find a target. So they find this target, they agree to a merger, and then what happens is the SPAC goes away, and then this company that they've essentially quasi brought public, they eventually winds up trading on its own, and that's the company. Okay, so that's generally the series here. And with some of these, SPAC managers, they might have a number of these, because every SPAC is I believe every SPAC has to be their own. I don't think they can merge with multiple companies. I'm not quite sure of that, but they look for these opportunities. So some of these people doing these might have a number of different SPACs and symbols, and those are issued at a certain date. You have 2 years to actually find an opportunity. So there's been a lot of, I don't want to call it controversy, but discussion back and forth on CNBC and other places. Are these good ideas? Are they bad ideas? And really, what you as an investor should be thinking about. Recently, somebody published an article. They sent it to me. Actually, it wasn't too recent. It was back in January. But I'll post it in the show notes. But this article on Seeking Alpha, one of the things they raised was the incentive structure. And so basically, managers, they have an incentive. They get fees. They get, whether it's promote the SPAC. But again, if they don't find an investment, you got to give the money back to investors. So the author of this article, it doesn't show me. I don't know why it doesn't show me the author's name. But again, I'll link to it in the show notes, because I thought it was a good article. But they pointed out that either the SPAC manager, I'm quoting from the article, either the SPAC manager finds an investment and keeps the large fees, upfront fees, and the promotion fees, or the SPAC manager has to give money back to investors. And so the author's point was, they're heavily incented, quoting again from the article, to find an investment, and inevitably they will find an investment whether or not it is good or not. That's the author's words, not mine. And so that does raise an interesting point with some of these. And I think it's worth noting that in CNBC, I was sort of surprised CNBC actually did this, because they've let some of these managers go on and essentially have like a half-hour infomercial about, the company, announce the company they're going to merge with, what the SPAC, the blank check company, was going to become. And, some of these have, I think in the case of Virgin Galactic, I have no idea if it's a good company to invest in. I honestly have not looked at their financials. I have no idea what they are. I don't think they've gone to space yet, right? Maybe that's coming. But in that case, you had a SPAC that probably IPO'd at one price and then went up considerably after the announcement of the Virgin Galactic. I mean, you had, that's a pretty big name. Richard Branson's involved with that. Of course, if you don't know who Richard Branson is, go ahead and Google him. He's been on Shark Tank. He's written books about business, any number of things. But there have been other ones, and I can't remember the name. I remember one day the guy was on CNBC, and he was, again, CNBC literally gave him like a half-hour infomercial where they're talking about the company that they're going to merge with and bring public via the SPAC IPO process. And I believe the SPAC price went down after they announced it. And probably people were like, oh, we thought we were going to have a Virgin Galactic or something more exciting. We got XYZ. I don't remember what the company did, but people weren't very excited for that. So that's the thing. If you're investing in one of these, you have no idea what company they're going to go ahead and wind up merging with and bringing public. And so if it's one that turned out to be a foundational, generational unicorn company, and you wouldn't have otherwise been able to invest pre-IPO, that may work out. If it's something that, isn't as exciting or perceived as exciting, right? Because perception's a big deal. That would sort of be detrimental to your investment. So that is one of the downsides. So how have SPAC companies done since they've gone public? Well, in that same article on Seeking Alpha, they pointed to some data that Renaissance Capital put out. And Renaissance Capital, according to them, they said of the 313 SPAC IPOs since the start of 2015, 93 out of the 313, completed mergers and they've taken the company public. And then they showed some performance data. Again, I'm reading this from the article. The common shares have delivered an average loss of minus 9.6% and the median return of negative 29.1% compared to the average aftermarket return of 47.1% for traditional IPOs since 2015. And so they also said only 29 of the SPACs in this group, which is just over 30% of those, had positive returns. And this was data through September 30th, 20. So that's actually kind of, now that's that's like 6 months ago. So in fairness, we don't have the updated data. And so basically, according to this, of these 313 SPACs, if only 93 completed mergers, and the article points it out, they either failed to find a target and return shareholder capital, or the SPACs are so new and they're still in the process of creating the merger. So that could be it as well. But the ones that I mentioned that were big is Virgin Galactic and also DraftKings. That was the other one. DraftKings was one that. So those two are sort of the big success stories. Again, I don't know anything about those companies' financials or anything like that. But so the reason I wanted to cover this is because I think these get some outsized coverage. And I mentioned the CNBC thing. So I haven't seen it as much lately, but I feel like a couple months ago, they would bring on one of these managers and the manager would talk. It seemed like they would talk for an hour straight. And, you could imagine if you had to buy advertising on CNBC for 30 seconds or 2 minutes, much less, a half hour. It might only been a half hour. I don't remember. Felt like it was an hour. But they just went on there and they talked about all of the different things, that were great about this company they were bringing public, and talked about their SPACs that, are upcoming and they're going to have target companies. And so it was this kind of weird thing where I just thought it was odd that CNBC let them do that because essentially it was a pitch, and that's fine, but it was just odd to me. So anytime something it's not new, but I definitely think their popularity, I've never seen them this popular before, raises a lot of interest, raises a lot of people searching on Google for them. But actually, as of, I think it was last week, an article in the Wall Street Journal titled SPAC Hot Streak Put on Ice by Regulatory Warnings. And the subheading was SEC Steps Up Scrutiny of Accounting and Growth Projections in Newly Formed, what do they say this was? Newly formed, newly public startups. And so, in the article, it was a good article, I'll link to it. Mentioned that SPACs raised $100 billion so far this year. So that's 2021. And last year was a record, but that was only $83.4 billion. And so this year, year to date, we're only coming into May now. That's quite a bit. And they mentioned these have been around for 30 years. So that's quite a record. But it does appear that the SEC, one of the things they said, it was either the last week or last couple of weeks, the SEC in the article said was largely silent about SPACs through most of last year, questioned the optimistic, and I'm quoting here from the article, questioned the optimistic revenue projections used by startups that are merging with SPACs. And the SEC warning could require some SPACs to restate their financial results, putting the brakes on new offerings. So there's definitely going to be some scrutiny in here. I think I've seen some reports that they felt like some of the disclosures or some of the projections were a little too rosy. So this is going to be an area to watch. So here's, I think the downside for investors are this. If you're putting money, so some of these managers have pretty big names. I mentioned Chamath. I didn't mention anybody else, but Chamath was the one whose company brought Virgin Galactic public through a SPAC. But the challenge is if you invest in one of these prior to knowing what the company is, you might be disappointed when they do pick a company. The other thing too is you have 2 years. So let's say you put your money into one of these things and 2 years goes by and then they say, well, we didn't get anything. We didn't find anything. So we're just going to return you your money. There is an opportunity cost to that. So your opportunity cost is, of course, what you could have earned in another investment, but you didn't because you were in this and you just wound up getting your money returned to you. And so that is a risk for investors. As I mentioned, you don't know what they're going to put the money into. And as the Seeking Alpha article pointed out, there are some incentives for managers in the form of fees, or I believe they also get whatever they merge with. I think they also get a number of shares that are carved out and given to them. So, and the article pointed out, the incentive is to go ahead and bring something public, and maybe that incentive might have a manager bring something public that potentially, maybe is not something that was the best idea, right? So that, again, according to the article. So when it comes to SPACs, I think you just have to be aware. I think you have to understand what they are, understand the incentive structure, the timeline of this. So again, you put your money in and you might have any number of time. And by the way, you can buy these after they come public. It just may not be at the IPO price. So you might have a SPAC that opened at, let's say, 10, and now it's trading at 18, and you still don't know what company they're going to bring public because they haven't done that yet. So these sort of trade. And if it works out, eventually your SPAC goes away. You wind up having shares in this new entity. And if it works out, great. So, but I think you just got to understand the timelines, understand what they are. And, like anything, keep your position sizing small here with regard to SPACs. And finally, one of the other things that I've noticed, by the way, anytime something gets really popular, by popular, whether in just the vernacular of the consciousness of the investment world or on CNBC or in magazines, you start to see some people not in finance getting involved. And I think this was as of March. I saw that Shaquille O'Neal, Steph Curry, Serena Williams, Alex Rodriguez, Colin Kaepernick, a number of athletes and other celebrities, I think, are getting involved in these. And I don't know what their involvement is or anything like that, but you are seeing those people come off the sidelines. So, and then finally, one of the benefits of this, though, is that if a company wanted to go public, I believe when they go public via SPAC and it's a merger, there's less red tape, less time, maybe less cost to the money, to the company, although I don't know that. So maybe there's something in the IPO process, the traditional IPO process, that all these SPACs might spur some change. Maybe there's some improvements in this process in the industry that could happen. So maybe that's something that could actually wind up being a positive. So, all right, folks, we'll leave it there. As always, rather than waste time and rating and reviewing and starring and doing all that, go ahead and pass this to someone that you might think might benefit from it, especially somebody who doesn't listen to a podcast. A lot of people listen to a podcast, but a lot of people don't know what they are yet. How do you get them? What player do I use? Where do I go for that? So it's always helpful if you can go ahead and forward the link for this one or other episodes to someone who will enjoy it. All right, we'll talk to you next week.